Now, what is the general reason why you like all these stocks? I know it may be obvious, but what is that general rule of thumb that you have?
General rule of thumb is reliability and consistent growth. You can have a high growth company where it's 50% growth one quarter and then negative growth the next. And those are we're not interested in those at all, because of course those stocks tend to be more volatile. The reliability factor is key, but it also plays back into the balance sheet. So any company with too much debt, we shy away from, because we don't know what's going to happen tomorrow in terms of the economy or the market, but we know if a company's sitting on a big cash position, their business is still going to be here, and they can get through the cycle. And this has helped us, and we don't pick a lot of oil and gas stocks, but it's helped us in that sector where it's like, okay, buy the one that has no debt, and then you're probably going to be okay for the next cycle. We like management interest in the company. If a management team owns 40 or 50%, that makes us happy. They're going to lie awake at night thinking about their business. In the small cap land, there's a lot of promotion that goes on. We like companies that basically don't do promotions. So if a company doesn't even hold a conference call, we're far more interested in if they do.
Interesting.
These are the companies that just go about their business. They execute well, and they know that their stock will go up if they do the right thing. And because they might own 20% of their company, they really don't care about the short term. I mean, from a stock market point of view, it kind of sounds counterintuitive to what everybody wants, but I would far prefer a company management team that cares about the 5-year period than the 90-day period.
Great. Now, moving on, I know, and some of us may know, Freshie went public this year. What are your views on it?
So we kind of like Freshie in terms of its growth potential. We weren't really happy with how they managed the whole process about the calorie labeling and things like that. I mean, basically, there's a rule you should follow the rules. You can't just sort of, pay your fine and move on. But the real issue with Freshie is valuation. So the market cap came out, and the valuation per store was very, very high. Now the growth rate was very, very high as well, but it's a scenario just like Aritzia, where their stores were being valued at $20 million per store for a small store in a mall, which to us was crazy. And that IPO hasn't done very well, just like Freshie. So Freshie, I think, is one to watch. We've considered following it, but we're not quite there yet.
Yeah, and to be honest, Freshie there's just so much competition with healthy food stores.
Yes, I mean, they've got a good solution. They've got a small footprint. The stores don't cost a whole lot to set up, and the average ticket per customer is pretty high because it's not really a cheap way to go to lunch. And so, they've hit the right combination there. And if they can get some good real estate and grow their 300 stores to 1,000 stores, which I really have no doubt that they're going to do. But they need to, make more money. So right now it's a show me story, and the valuation, even at the lower price, is still pretty high.
So your recommendation is to keep an eye on Freshie.
Absolutely.
Great. Now, so moving on, just once again, is there an alternative to gold as a flight to safety investment? Your thoughts?
It's a bit of a mixed view. I mean, not really. Gold is as a store of value, as a place to go when people panic. It still is kind of the gold standard. In the 2008 crisis, there was only 2 asset categories that went up. One was gold and one was the US dollar. Unfortunately, they compete against each other because the price of gold is in US dollars. So if the US dollar goes up, it actually hurts your gold exposure. But that's where people will go in a crisis. And, there's all these people that one day expect the US dollar to completely crack because they're printing too much money. And that'll be when you really, really want to own gold. So we recommend right now 5% gold. We're not too worried about what's happening in the world. The markets are okay. Interest rates are okay. Gold, of course, doesn't pay you a dividend to hold it. And it doesn't, it's been pretty bad investment for the past 5 years. But it's like insurance. You need insurance before the hurricane, not after.
For sure. And do you have any thoughts on CGI Group?
CGI, they had a bad quarter recently, but I really like the backlog. I don't know exactly what the backlog is, but I think it's in the $19 billion range. So that, again, it goes back to that reliability. It's like, here's a company with $19 billion in firm orders. So the next 3, 4, 5 years are covered. And the stock's relatively cheap. They had some hiccups with Obamacare, but that was such a small contract that it created an opportunity for the stock. And we like it. It's not our favorite tech name. We'd rather buy Shopify or OpenText or Constellation Software, but CGI is definitely viable.
Now, I want to move on to another company. It's called Prometic Life Sciences. Now, it seems to have positive aspects, but it's struggling. So about how long do you think it'll take before it starts to deliver?
Yeah, we've been a little disappointed in Prometic. It's in our growth portfolio and hasn't really done a whole lot for us. Technology that takes protein-based compounds and turns it into more effective novel drug compounds. And so they've got a lot of partnerships working on new drug applications. They've got a new product, I think it's called plasminogen, coming out this year, and their trials are proceeding. The big issue with any healthcare company is their financing situation, and a lot of people were worried about that. So they've raised money this year, sort of takes that off the table. But the stock is down 29–30%. Of course, the Concordia Valiant sector issue and the US healthcare sector issue hasn't helped them at all. There's still potential there, but it's time to, like any stock, you need somebody else to like it as well, or it's time to move on. So we're kind of watching it. We like it, but we don't like it as much as we used to, because for 3 years now, it really hasn't done much.
Great. So John Fleming asked us to repeat the name of the third stock one more time. So the third stock was Photon Control.
The one I forgot.
Yeah, Photon Control, which trades as PHO.
PHO, yeah, it's about $1.48.
Great. And then the other one, Severia, the stock symbol for that one?
SIS.
SIS, all right. So I hope everyone caught that. So it's SIS for Severia, PHO for Photon Control, and of course for premium brands,
PBH.
it was PBH, all right? So moving on to the next question, how does beta stocks play a role in your portfolio makeup?
Okay, so beta is the definition of how a stock is performing versus the market. So if you have a beta of 2, then you're twice as volatile as the market. The market goes up 10, you're supposed to go up 20. Market goes down 10, you're going to go down 20.
So low volatility stocks.
Well, it depends on the actual beta. So you could have a portfolio of very low beta stocks, and in theory, your portfolio is going to be much less volatile than the overall market. It is something to consider, but it really depends on the makeup of the investor. Frankly, I'm so used to stocks going up 15–20%, down 15–20%. It's like almost irrelevant to us as investors. If the fundamentals are fine, we don't really care that much if the stock bounces around. Again, because the stock movement is all short-term based, but the fundamentals are long-term focused. So, nobody likes a stock that bounces around, but it almost always means that stock is cheaper. So if you can get a cheaper stock that has strong fundamentals, it's going to be a much better investment than an expensive stock that doesn't bounce around.
Now, Roy Thompson asks, for gold, do you recommend holding gold or gold miners? And if you say gold miners, which companies?
It varies dramatically based on the valuation. So at certain points in the cycle, gold stocks are far, far cheaper on a valuation basis versus gold bullion. And then at other times, it's the reverse. Key difference is whether you want to have gold exposure as insurance or as a potential profit maker. If you want it as insurance, you should have gold bullion and gold bullion only. When there's a crisis, stocks go down, and gold stocks can go down pretty hard in a crisis, but bullion is what people want. If you want to have a complement to your portfolio with exposure to the gold sector with potential to make money, then go for the gold stocks. So it can go either way based on what you want to do.
This is a bit of a longer question, so bear with me. So with renewable and alternative energy looking to change and drive the source of energy going forward, do you have any interesting names at this time?
Sure. So we're focused on Canada. So there's a few names in Canada that we like quite a lot. And when we first covered Brookfield, a lot of people thought, oh, it's just a boring Brookfield company, but it's done very, very well. They have international exposure. They've got good exposure in Brazil, and their earnings and the cash flow bounce around quite a lot. And people think, oh, it's they don't know what they're doing. But their earnings and cash flow bounce around because it's all based on the watershed levels of their hydro facilities. And so, they have a good year, they have great earnings, they have low water levels, they have bad earnings. But in terms of sort of consistent dividend increases, distribution, it's a little bit different. In terms of performance, reliability, it's well up there in terms of some of our favorites. Algonquin Power would be another one. They're very big in renewables, and they continue to raise their dividend. I think they did it this year as well. It's a much smaller utility, but again, smaller typically means faster growth, and that would certainly apply.
Great. This goes back to what we touched upon in the very beginning of the interview, or our Q&A, and it's talking about adding U.S. exposure to the portfolio. Now, someone else named Giles said, when considering dividend and some growth, what would be your two best stocks other than FANG stocks?
Okay. I mean, we don't cover U.S., so this is, take that with a grain of salt.
Right.
But in terms of a theme, you know, we really like NVIDIA. So everybody knows NVIDIA because it's done so well, but there's a reason for that. If you touch on all the hot sectors right now, automated driving, artificial intelligence, virtual reality, cryptocurrencies, and gaming is still hot as well. They hit all the buttons, and their growth rate is fabulous, and it's a very expensive stock, but it's hard to see any of those sectors reversing anytime soon. It's a cyclical business, but I think you've got a few more years before artificial intelligence goes away as a theme. Another one is sort of along the same lines, but far cheaper and far more industrial based is Cognex. It's CGNX. And CGNX, yeah, and it is a company that no one's ever heard of, and they make machine vision technology. And so a lot of that is for factory automation, robotics, where there's scanning automation lines to make sure everything's okay. But it also, of course, has other applications as well. Once you're sort of using a machine vision to create data to use, it has other applications as well. And so they had a blow away. 3 or 4 quarters have been blow away quarters, and now it's up to 10 billion market cap, but still it's not really widely known.
So moving on, what would you say is your recommendations for investors seeking income, of course, in this low interest rate environment that we're in?
Sure. I mean, this is a big question because people are concerned about what will happen to bonds and what will happen to income stocks when rates rise. And there can be an impact, but the question is the rate increase going to be surprising? And I think it took 10 years for the Bank of Canada to raise rates, and I don't think anyone is going to be surprised, you know, with the next rate hike. So it's a question of expectations versus reality. So I wouldn't be too worried unless inflation massively picked up, which, you know, you'll see in the headlines, but it certainly hasn't happened yet. So I think convertible bonds would be a nice way to go if you want to have sort of some protection and some upside. You're at a higher ranking than equities. You get an interest payment, and you get an equity kicker if things go well at the underlying stock. So I think that's fine. Some people are preferred shares, and I don't think you need to completely avoid the whole sector, but some of the minimum reset preferreds are probably the way to go these days, where you don't have a reset preferred that goes down really low if rates go back down to zero. Some of those are fine.
Right.
There's no need to sort of avoid that sector, but just look at your income needs versus your overall portfolio.
Right. So would you say then that it is a better alternative to purchase individual high quality corporate bonds offering a decent rate?
Yeah, I mean, yes. I mean, you could set up your own bond portfolio for sure if you wanted to, but I would rather see someone at this point in the cycle own some convertible bonds and maybe own some preferred shares for the dividend tax treatment. Some of the problems with some of the bond ETFs and some of the preferred ETFs is they're paying premiums for their securities, and so when those premiums mature, they're losing money. So they have a nice distribution, but at the end of the day, their net asset value might be decaying a little bit because they're buying a bond at 105 and getting it redeemed at 100. So we would use a little bit of caution there. Again, it's an easy, simple, diversified solution, but if you can do your own portfolio, we'd definitely prefer that and skip the fees altogether.
Right. Great. Now, you mentioned this earlier, but Kinaxis. Let's just touch upon that one again, because Eugene told us that he bought it at a large discount. Is it a good buy?
Well, we like the company a lot. So from a stock perspective, very expensive stock. Their growth rate's been phenomenal. They have a big cash position. Management knows what they're doing, and insiders have a nice piece. And they're growing their business such that they're a global company where one of their customers might buy 100 seats as a test, and then they like what they see with their software. It just sort of helps companies with their whole inventory sales cycle. So they like what they see, and then they go from 100 seats to 10,000 seats.
Right.
And their average customer order is getting much bigger, and that sort of confirms that thesis. But they'll have their ups and downs, and it's a situation where any expensive stock that has an earnings slowdown or even a potential earnings slowdown gets hit with some profit taking. So it may not be as strong over the balance of the next year as it has been over the past few years, but it's a really good company in terms of execution. potential reliability.
Great. Now we only have 5 more minutes left with you. Time flies by. It's been 40 minutes already. So before we close, are there any ideas or topics that or is kind of under your radar that we haven't talked about so far during this webinar?
I mean, there's a few. We're watching some companies that we may or may not cover in the future, but there's certainly some companies that are out there that we're keeping an eye on. Intrinsic Technologies is one that it hasn't really done a whole lot for us recently, but we kind of like the potential. And again, it's been around for 20 years, but it's one of those situations where things are starting to
so now we're
better for
seeing
it.
them.
Absolutely.
Right.
And the one that we really are proud of is Spin Master. So they make toys. I mean, some people have heard of it, some people haven't. But when you look at Mattel in the U.S., Mattel is basically almost dying. They've got debt situation. They're horrible. And meanwhile, this Canadian company, Spin Master, is hitting all the right products out of the park.
Right.
And their stock has done phenomenally well, and it's now a $4 billion company that very, very few people have heard of. They've only been public for a few years. So the situation where we love it when a company is doing better than an industry. So that tells you they're doing something right, and then you just have to say, okay, what are they doing right?
Right.
In Spin Master's case, they're just doing everything right. And in the toy sector, you have to have the right products, and they just have the right team creating the right products. So
when you Master, though, why'd you get into it?
We like the potential. We knew the company when it was private, and it's a situation where they had some success early days in terms of product development. And it's one of those situations where it's kind of a bizarre stretch, but when you have an oil and gas team that can find hydrocarbons, you want to stick with them because that's your advantage. I mean, the price of oil is the same, but if you have a team that can find it better than someone else,
for sure,
you're going to do well. Same thing with toys. If you have a team that knows the business, knows the kids, then you're going to be able to create a product that the kids are going to want. And that's exactly what Spin Master has done in spades. Another group that, company Altus was a company that they provide real estate services and other technology, software technology. Okay. And the stock hasn't done anything until very recently, and then it just made a huge pop on great earnings. One where sometimes you have to have patience. Sometimes you might have a great story where this is a situation where they were developing market share at the expense of short-term profits. And so the short-term investors said, yeah, I don't like you.
Right.
But then when that earnings starts kicking in, you realize, okay, this is what they were doing in the first place, and now it's all working out.
Right. Well, unfortunately, that's all the time we have for today. So thank you so much, Peter, for being here with us.
My pleasure. Thank you.
Thank you. Now, to learn more from Peter, of course, you can go to 5iresearch.ca if you haven't visited the site already. And if you want another webinar, feel free to reach out. You can always email us at info@smallcappower.com to give us feedback or, again, to request another webinar. Thank you so much. I'm Rachel Lee.